Welcome back. There's a lot going on here today. We've got a big IPO. Markets have opened higher to kick off Thursday morning as Microsoft and Meta kick off tech earnings with a bang. All of the markets digesting yesterday's Fed decision as well to hold rates steady as expected. Joining us here on set is RBC Head of U.S. Equity Strategy, Lori Calvasina. Welcome back. It's nice to have you.
Thanks.
I was just saying, I believe you've been a little bit more cautious than the rest of the equity strategists out there, and yet this market continues to make record high after record high, and Magnificent Seven proves why they're so magnificent.
Yeah, no, and look, I think the reality is the challenge this year has been, from a sentiment perspective, the market seems like it could run, and it's done that. And it's about where it deserves to be if you take an uber bullish perspective and just look at the sentiment modeling. If you look at valuation and earnings modeling, we're way over our skis for 2025. That's just reality. We're also trading ahead of where we should be from a GDP perspective. 1% to 2% GDP is not usually a great backdrop for the stock market. So it's just been one of these years where the sentiment work says it's off to the races. Other, kind of more traditional metrics ask you to be a little bit more cautious, and we try to bridge the gap between the two.
I mean, the earnings movers are stark, either up or down.
Yeah.
I'm looking at Align Technology down 30% right now. eBay's up 16 at the top of the S&P, and then Meta's up 11. What's your overall read on earnings?
So I joke, I mean, a data nerd joke here, so indulge me, but I'm an old small cap strategist, so I look at the moves that we see and I sort every day the movers, and it feels like I'm back in my small cap strategy days where you're just getting these massive gaps up and down, and that tells you something about liquidity in the market. It tells you something about visibility into some of these earnings on both the good side and the bad side. But, one of the things we said in our weekly after kind of going through everything last week, some companies are able to manage around these challenges better than others. And so we are sort of in a situation where it's a stock picker's market. You've got winners, you've got losers. Generally, I think corporate America is managing through pretty well, but that's not equally true for everybody.
Well, you say fine, but not fabulous. We just showed that. Is that what you continue to believe? And what does that mean overall in terms of valuation and why you may have perhaps more caution than a number of the other strategists on the street?
Well, look, I think what's interesting in here right today, we're seeing these big tech names doing well. The AI story seems very much intact. Normally we go through some of these reporting seasons, right, and the spotlight gets shown in a favorable way on the rest of the market because people, frankly, are finally forced to pay attention. Tariffs and all these, issues we're navigating are not allowing to do that, but the AI story is still intact. So let's look at the valuations of those names. We watch every week in our weekly the top 10 market cap names and just a median PE, forward numbers, constantly updating the E. We're getting close to the recent peaks. We're not quite there, but we're getting very close.
Which is what? What number?
It's around like upper 24 number, almost 25 times.
Okay.
And if you look at the rest of the market, we've had, I think, like an 18.5 time median PE. So there's been a need for a catch-up trade there, but you're not really getting a basis for that so far from these earnings, right? It's still the earnings are still kind of pushing you back into the more overvalued bucket to the market. If you look at the CFTC data, right, where you can watch NASDAQ 100 futures positioning, that's not quite back up to past peaks either, but it's getting pretty darn close.
Yeah,
so,
but I mean, these 10 names are probably some very large percentage of the overall S&P at this point. I don't know where they are. What, 20-something%?
I think we look at net income, and I think it's like maybe 40%. I'd have to go back and double check.
Net income and market cap overall as well. I mean, I wonder.
It's like in the 30s.
Many of them are growing top line at rates that are far above what the rest of the market is, and therefore deserving perhaps of PEs of that level.
I agree with you completely. And, I'm kind of agnostic on this debate, right? Like, I'm not a Kool-Aid drinker, right? I'm never the one who's going to, be in love with whatever the latest fad is. But I do actually push back on the skeptics a little bit, because when we take that relative median PE between the top 10 and rest of market and we compare it to the relative long-term growth expectations, so that goofy 3 to 5 year earnings growth number that everyone tells you is nonsense, well, it's actually not nonsense because that relative earnings growth rate tracks the relative PE almost perfectly. So you're getting the bigger multiples that you deserve because of the better longer-term growth rates.
I mean, clearly Meta and Microsoft don't need rate cuts, but there are plenty of S&P companies and small caps that would want that and do need that to work. Do you think the market's going to be disappointed? I thought Powell was actually pretty hawkish yesterday and did not set up for a September cut.
I felt like listening to his press conference yesterday, it echoed a lot of what we heard in earnings last week, and I forget exactly how he phrased it. Was it a long way to go? And we never thought this was going to be fast in terms of seeing those tariff impacts to the inflation data. I feel like this is a slow process, and you've had a market that has recovered faster off the April 8th lows than any other growth scare that we've seen. And it's really just remarkable. And I get it in the sense that people said we paid the price for all the wobbles and whatnot. But at the same time, when I got into my June marketing, it went from we've paid the price, which was the story I heard back in May from investors, to everything's going to be fine. We're not going to get any inflation. We're not going to get any damage. And that June conversation has what's concerned me, because I think once we get past Labor Day, you have to go back to 2018. In 2018, September conference season, companies came out and said, hey, we are going to encounter some problems from tariffs. And that threw some cold water on the market, among a number of other things.
But at the same time, we really are seeing a softening in services. You see that in the super core measures today, which the Fed has watched before. They actually came down.
Yeah, and look, you're seeing consumers adjust the same way corporations are adjust. And I think the issue I'm trying to sort out as a strategist is these buffers, how long are they going to last? And what happens after those buffers run out? There's still an incomplete discussion in these earnings calls about demand. We know that some people just powered through. You're hearing a lot of that from the AI-related companies. Some people pulled back. Some people pulled forward. It is a mess in terms of what was actually done demand-wise, and I frankly don't think we're any closer to sorting out what the setup is for the next quarter than we were a few weeks ago.
Yeah, you sound like Powell there. Thank you.